AM says, build and glued is I'm not sure what language that is, or if that's simply spell check gone awry, but greetings, Bruce. This gives me a big yes. Thanks, Bruce. Michael, Andy. We're going to have a little bit of a delayed effect here with the YouTube crowd. They're going to be cutting in here in a second, and hopefully I'll be able to see them in the chat as well. Very awesome. I logged in a couple minutes early here. I always like to do that just to make sure we're all set up from a technical point of view. My colleagues at NinjaTrader are helping me run the show. For that, I am grateful. And Lou gives me a good morning. Good morning, Lou. Very awesome. Great. Thanks for being here. Anthony, Andy, Brian, DeVoe. Awesome. Love your last name. French, maybe, New Orleans. What are we talking here, Brian? AM says, I'm from Holland. Welcome from Holland. Really, really excited you're here. My guess is we have some folks from all over the place. Louis says, yes. Awesome. Oh, Luis. I'm sorry. Is that Luis or Louis? I don't have my glasses on. I can't read anything. I got to put the glasses on. I still can't read. The font's too small. Bree, I could make that one out. What's up, Jim? Hey, what's up, Bree? Thanks for being here. We're going to get started here in 2 minutes right on time. And really, this is the second event today. You know, we did a live trade setup event earlier today, which the good news is that, you know, we could take our time and spend as much time as we need, right? We're not under the gun to wrap things up quickly. So, you know, type in questions, comments, observations, hopes, dreams, loves, whatever you want into the chat box. And I'll be happy to try to pick up on all that. Missouri is in the house. Rod Father, awesome. I'm glad you're here. I'm in North Carolina myself, so I'm a Southerner, just like you. I'm a new Southerner, brand new, 2 months into the South. Love it. Everything's good. Everything's friendly. I miss my camaraderie that I had in the NinjaTrader office, headquarters in Chicago. Beautiful office, beautiful people, great organization. Kind of miss it, but I'm not going to miss the snow. That's for sure. All right. Very cool. All right, so we're going to get started. Yeah, a couple seconds here. Hang tight, everybody. We're going to get on it. I got the NinjaTrader platform showing right there. It is actually exactly time to go. So let's get started. And let me get a couple screens going. And so officially, hello and welcome to today's event, Futures Trading 101. My name is Jim Cagnina, and I'm the Senior Education and Training Specialist for the NinjaTrader platform. We are primarily focused on futures trading today. And I do want to remind everybody, if you don't already know, futures and options on futures are not suitable for all traders and investors. Oftentimes in futures trading, we are exposed to a large combination of leverage and volatility. And all that, although that's an equation for opportunity, which is my guess is why we're all here, it's also an equation for risk. So only fund your futures trading account with risk capital. I understand everybody in this world is unique and different. That's what makes life great, right? But my personal definition of risk capital is this: money I could afford to lose, which doesn't change my lifestyle, doesn't lengthen my retirement horizon, or doesn't overly anger Mrs. Cagnina. Now, I understand this third part's a little tongue-in-cheek to some people, but stress in life matters. It's really not. Stress in life matters. When we're under stress, we tend to make bad decisions. At least I do. So if you have any questions on risk, just type them into the box, easy on the day trade margins. And I'm going to go over all of that today for those of you who are brand new to futures trading. And it doesn't matter if you've never traded anything. You're in the right spot. We're going to talk about trading in general and really get into this whole idea of the prospect of futures trading. I'm going to be using the NinjaTrader trading platform today. I'm logged in to the software in simulated live mode with real-time data feed. And so I'm going to be doing a lot of explanations using the actual software. So feel free to pop in. No PowerPoint today. Thank goodness. Everyone's probably relieved about that. Again, type in anything you want in the question and answer box. I will try to get to it. All right, so let's get started here. I mean, futures trading isn't new, right? It's been around a long time. Trading's been around a long time, right? If you remember your world history from high school, you know, the Greeks and the Phoenician merchants, they established these trade routes and trading partners throughout the Mediterranean. They would trade goods back and forth. And this is a normal, natural human being kind of thing we do, right? And then fast forward a little bit to 1571, and then the Royal Exchange in London was officially formed and signed off on by the Queen, and that kind of really started the focus of organized trading, right? Organized trading of securities and of goods and services and of commodities. 1667, the Dojimi Rice Exchange, right, in Japan. You might recognize the word doji from Dojimi Rice Exchange, which is a candlestick patterns that we look for. 1848, CBOT, Chicago Board of Trade. This is where I am from, born and raised, lived there for 57 years, more or less. Chicago Board of Trade really created the world's first futures exchange, right? And that was based in Chicago. In 1870, Chicago Board of Trade develops the first octagonal futures trading pit, right? And we'll talk a little bit about that in a second. 1898, Chicago Butter and Egg Board, which was formed, which is really the predecessor to the Chicago Mercantile Exchange, which kind of got formalized after World War I, right? So I started in the octagonal trading pit of the Board of Trade in the early 80s. I was in the Treasury bond futures market at one of the largest trading pits in the world. And there was no electronic trading back then, right? It was all done by telephone and by hand signals, right? And so you'd have all of these folks congregate in this trading pit. On this huge room at the Chicago Board of Trade. And, what retail traders would have to do, and there were very few of them back in the day, you would have to pick up the phone and call your broker, right? And maybe your broker was located on the floor. Maybe your broker was located in the office across the street, and you would read them an order, right? You would say, I would like to buy one E-mini S&P contract. Well, the E-mini S&P didn't exist back then, but if it did, you would say one E-mini S&P contract at 44.23 and a quarter. And then the guy on the phone would take, gal on the phone, whoever it is, would take your order, write it down on a card, punch stamp it in a timestamp, then call the floor, and then some guy on a desk on the trading floor that's located right outside of the trading pit would take the call, and the broker would say the order. And this person then would write your order on another piece of paper and hand it to a runner, which was me. And I would grab that piece of paper and run it over to the broker as fast as I can to the side of the pit. Now the broker stood on the top rung on the outside. Sometimes we did hand signals to flash the order. Sometimes we brought the piece of paper to them. They'd turn around and they would execute the trade with everybody else that's participating. And the pit had their own version of retail traders called locals, right? People that weren't hired by a brokerage firm to fill orders and get a commission. They were there trying to buy and sell and speculate, really. So then by the time your order was filled, then a piece of paper would go back to the desk, and then they would call the broker, and then the broker would call you and say, hey, you were filled, and sometimes this process happened right away. And sometimes this process took half an hour, 3 hours. So it was less than efficient. And the retail trader retail trader meaning us, right? We really didn't have the ability to participate, right? We didn't really have it was just inefficient. You didn't know where the price was, and it was kind of messy. But then something really great happened, right? Excuse me. Oh, by the way, the S&P market that I was referring to here, that thing was launched in 82, right around when I started, right? So in 82, the big S&P contract, not the E-mini, the big S&P contract was pit traded. But now in 1992, 10 years later, the first electronic futures trades are made on the CME Globex electronic trading platform, which we still use today. It's in a much more beefed up format right now, but we started trading electronically in 1992. And so then for folks who had the ability to access this electronically, then they were able to bypass that other process and trade electronically online. But really, what really started changing things is when the E-mini S&P was launched in 1997, because it was a smaller size contract, right? In 1997, E-mini S&P was launched, smaller size contract 24 years ago, and it expanded the participants greatly, and the folks that were able to participate in trading, especially the stock index futures, right? I think the Dow was also launched back then, if my memory is correct. A smaller size contract. It was electronically traded. It was fair, first in, first out. No matter where you are, if you had a decent internet connection, you saw the same prices that everybody else did. 2002, CME becomes first U.S. exchange to go public. And then in 2007, the CME and the Chicago Board of Trade officially merged. 2008, CME acquired NYMEX. And now this is where really the rubber meets the road next, right? May 6th, write this date down. You don't have to write this date down, but May 6, 2019, the CME launches a series of micro E-mini products, including the micro E-mini S&P, the micro E-mini NASDAQ. And this really provided retail traders, were accessible to everyone. Retail futures became accessible to everyone. And then that's a quote from somebody, an NinjaTrader actually. And it's true, right? Now anybody could participate because the amount of risk capital that you have to allocate is flexible now, right? Because you could trade on a smaller size contract. And I'm going to get into detail on that in a second. In more detail. Overall, the CME notional value of contracts traded is just phenomenal. And let me see if I have a cheat sheet here to show you what that might be. I'm going to bring over the CME Group home webpage, and you'll see all the different asset classes here. And this was September's notional value of contracts traded, and it's in the billions and almost trillions, right? The equity indexes alone, the things that we've been talking about, the E-mini S&P 500, the Dow Jones, the Russell 2000, the NASDAQ, almost $1 trillion in notional value. So these are all of the asset classes, and we're going to talk about those in detail today. Very cool statistic. Now, you see the NinjaTrader platform in front of you. It looks complicated if you're brand new to futures trading, but it's really not. It's really easy, intuitive, and simple. And this is just how I have my desktop set up, right? Some folks have multiple monitors. They have a whole bunch of different charts showing. They have different trading ladders showing and all that stuff. And I'll go through these piece by piece as we go. But really, the idea of this market being kind of a scary, a more scary type of endeavor is not true, right? It's not true because you're not forced to take more leverage than you want. You could trade to whatever level you're comfortable with, right? And it's really a situation where there's three outcomes, right? The price of the market that you're looking at could go up, the price can go down, or the price could stay the same, right? And us as traders, we have to decide, hey, do we think, is our opinion that this market's going to go up in price? Is our opinion this market's going to go down in price? And then we could form a strategy. And do we want to buy and sell at a higher price? Do we want to sell and try to buy back at a lower price? And these are things that are within our control. And it's as simple as that, right? We're tracking price. And as a matter of fact, when you wake up in the morning and you turn on Bloomberg or Reuters or Squawk Box or whatever you're listening to, they're quoting the futures markets, right? They are quoting that. You see that quotation across the board, and there's a lot of really great reasons for that. So we're going to explore this. We're going to explore the software a little bit, and hopefully it kind of helps ease everyone's mind that this is really just this isn't overly sophisticated from a starting point of view. Anybody could participate that wants to. Again, any questions so far, type them in. Be happy to grab them. It looks like, oh my goodness, we got a whole bunch here over. M. Bartlett says, I don't want to anger Mrs. Kaggs either. You don't, believe me. Well, Rodfather, I'm not going to comment on that particular platform, but I'm very convinced that folks are going to have a good experience with the NinjaTrader platform. So, okay, so control panel upper left does a lot of stuff. You could open up as many charts as you want. You could open up as many trading ladders. You could customize a quote board, which I have. We have a bunch of tabs at the bottom here that gives you different information. And I'm in a sim account right now. We're going to be focusing on the one I just highlighted here. This is a real-time sim account. And I'll go over what all this stuff means as we go forward. Market Analyzer is simply a quote board, right? It's simply a quote board. And the way I have mine set up, and it's very customizable. There's way more columns you could add to this quote board than I'm showing right here. And we go over that in some other videos. But the way I have mine organized is I have my stock index futures at the top. I have the 4 ones that I track. Well, really, there's 5 on here, but the E-mini S&P, the NASDAQ 100, the Russell 2000, which is at the Dow Jones, and the FDAX. ES, everyone knows what the ES is, S&P 500. That's large cap US stocks. NASDAQ, it used to be called the tech stock, NASDAQ 100, used to be called tech stocks. But really now it's not, it's non-financials, right? There's non-financials in there. You won't see Goldman Sachs in there as an example. RTY, that's the Russell 2000. And the Russell 2000 is small cap stocks, right? And it's kind of a weird definition because there's a Russell 3000 and the Russell 2000 is the smallest small caps within the Russell 3000. It's kind of weird. And then you got your blue chips, your Dow, there's 30 in there. And it's kind of, this is a famous stock index, which is also tracked and tradable. And then FDAX is at the German exchange. There's some stock index futures at the Eurex exchange in Frankfurt that are very liquid and very tradable. The Euro Stock 50 comes to mind, and there's micro products on those. And then the DAX is another one that's very popular. And then before I go down any further, you can see the last traded price, the daily volume, right? And look at this. I mean, the E-mini S&P already has 714,000 traded today. And then the net change, and you can see we had a tremendous rally today in the equities. Now, my next area here is the micro stock indexes. They are the exact same as the big ones. They have an M in front of the ticker symbol, M meaning micro, and they're 1/10 the size. They're 1/10 the size of the big ones, right? They're smaller. Their prices are virtually 100% in sync with their big brother, big sister contracts, right? So they're 100% correlated, and there's reasons for that. But maybe every instant you'll see a tick that's off for instantaneously, but pretty much they're in sync, right? They're nearly 100% correlated. And these micros are what I was talking about before. It virtually it opens up the door along with electronic trading that the CME provides. So, their electronic trading trade engine, matching engine, the Globex system is super quick, super efficient, and it's transparent, and it offers trades on first come, first serve basis, which is fair, right? But I'm kind of getting ahead of myself a little bit. But the micros here are right underneath it. Underneath it, I have currencies and Forex, and we'll talk a little bit about why these are better. We'll talk about it now. Why would I trade a futures currency instead of a over-the-counter Forex market? Well, okay, a lot of reasons. One, these are traded at the CME Group, right? In a regulated, a highly regulated, publicly traded company owns. It's in that umbrella. All eyes are on it, but really it's a couple of other things that are equally as important. And number one is, the trader, let's take a look at the yen-US cross. The trader in Tokyo is going to see the same pricing, the same bid-ask spread, the same information, the same volume that a trader in Australia is going to see, that somebody in Brazil is going to see, in Los Angeles, in London, in Holland, by the way, you're going to see that same pricing. It's going to be transparent. And then you're going to be able to send orders and compete with everybody else in the world on a first in, first out basis, right? FIFO. Maybe you remember that from accounting class. FIFO, first in, first out. I did not do well in accounting. So, but I do understand what it means here with respect to futures trading. So now now you don't have to worry about different third party over the counter currency cross forex dealers, right, that make their own market. And maybe they're using EBS pricing and coming up with some kind of algorithm to give you a bid offer spread. And maybe it's a tight bid offer spread, maybe it's not. But my guess is if you had 3 different or 4 different over the counter forex accounts, and you tried to place the same trade in all 4, you would get 4 different prices, right? Because it's not centralized. Pricing is unique to that particular over-the-counter entity, right? And some of them aren't, I know there's a lot of regulation going on now, but that's another area of why you'd want to trade futures over or some of the spot instruments that are floating around here. There's no carryover interest, right? Holding things overnight, you don't have to carry over. There's no 3 to 5 day settlement process in futures trading when you close a position like you do in forex. So anyway, I know I'm kind of spending maybe a little bit too much time on that, but great markets to trade. You have all the major crosses. You have some of the minor crosses also. The only one that's a little bit different is like I have the yen here. It's the yen US dollar, right? So Aussie US dollar, British pound sterling US dollar. So that's the way the cross is set up. Euro, Canadian dollar, the yen. In spot, it's the opposite, right? It's the US yen, but because they can't deal with the decimal point. Mexican peso, New Zealand dollar, Swiss franc. I'm sorry, New Zealand dollar, Swiss franc, and so these are all pretty good markets. There's micro versions of those markets. I'm moving down my list on my market analyzer. We have energy markets. We have the crude oil, and then there's a micro crude oil, right? 1/10 the size. Natural gas, and there's others in the energy complex which are very liquid and very tradable. And maybe that's where your interest lies. Metals, precious metals, industrial metals, gold, silver, copper, platinum, palladium are within that category also. Treasuries, you have the entire interest rate curve, yield curve. Sorry, you have it from an ultra bond, which is a true 30-year duration bond. The regular treasury bonds, where the duration, it's a 30-year bond, but the duration of this portfolio is a little less than 30 years. This is where I started my career. And, back in the day, it was wildly popular. Probably the biggest pit there was back then. And remember, the S&P pit just started back then. And, we've done 258,000 contracts already. That's a pretty good day. 10-year notes, you see it all over the news, right? You got the ultra notes and you got the regular 10-year notes, and you see it all over the news, right? What's 10-year yield doing today? It's the first thing they talk about when you log in to your news feed. And I'm going to get to some of these questions about the platform and stuff. Hang tight, guys. Then you got 5-year notes, 2-year note, 3-year notes, 2-year notes, Fed funds rates. And so that represents the entire yield curve. You could express your opinion and your ideas by trading any of those instruments. And if you're interested in the interest rate complex at the CME, they're terrific markets. Now, I kind of ran out of room here. I got cryptos. There is a crypto. I'll talk about cryptos a little later. Micro Bitcoin crypto. You could tell by the tone of my voice, I'm not a huge fan. And then underneath it, and I didn't put my category in there, are the grains, right? The traditional commodity markets, right? Corn, oats, soybean meal, soybeans, wheat. And this is, a lot of people think futures trading is commodities. They think it's just that. Sugar, coffee, cocoa, grains. That's all true, but it's all of these other asset classes, right? All of these other asset classes. So this is all this is. This is just a quote board. This is all this is, the market analyzer. It's not that complicated. Now let's take a look at this. This is where the rubber meets the road right here on this trading ladder. This is unique to futures trading. Terrence, on the market analyzer, sorry, hang on a second. Let's reverse for a second. I didn't see that question. On the market analyzer, you're just going to create it. You're going to go to new, and you're just going to click on Market Analyzer, and it'll give you a new one. Or if you haven't launched one already, it'll open up the window that you could customize. It's really, really straightforward and easy. So it's something you create, right? It's something that you could customize. You could add columns to this. You could do all sorts of customization stuff. So thanks for that question, though. All right, so let's go to the trading ladder, right? Why is it called a trading ladder or a depth of, well, there's two terms of art. Let's start with trading ladder, right? And it's a ladder. Prices are laddering up, right? Every step up the ladder is the next price up. And each increment is the smallest increment that this particular market could trade at. And the smallest increment's called a tick, right? These are the smallest. Each step on the ladder up is a tick up. Each step on the ladder down is a tick down. In this particular market, you can see that the yellow flag in the middle, and I'll freeze it by putting my mouse on here, 44.22 1/4. That just is highlighting to the user that, hey, this is the last traded price. This is the last price where buyers and sellers agreed to do a deal. Now, we didn't really agree to do a deal, right? I didn't call you and do a deal, but this is where the CME Group electronic marketplace are matching orders on a first come, first serve basis. And this is the last price. And so you can see it's moving around, right? Because there is this tug of war between buyers and sellers and supply and demand. It's going back and forth, and that's what makes this market move around. And in trading in general, what we want to do is we want to buy low and sell high, or sell high and buy low. And, we do our technical analysis and fundamental analysis and come up with trade ideas, right? We do that every Tuesday and Wednesday as part of the NinjaTrader training series of events. I welcome everybody to come. It's free. We have a lot of fun, and we look for trade ideas. So that's kind of the latter part. This is the latter part of what we're seeing here on the Superdome. Now, DOME stands for depth of market, right? Depth of market. What that means is you'll see a bunch of numbers on the left-hand side here. See these numbers here? This is the bid or the buy side. We can call it the buy side. This is where we buy contracts. Or the bid side, right? And you can see these numbers 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 ticks down, right, from the last traded price. These are contracts that have been sent to the exchange that are waiting, that are in the queue or in line in the CME Group's order book, waiting to be filled. Some of them will get filled, some of them won't. The price might not, as an example, the price may never get to 44.21, and these 174 contracts don't get filled. Or maybe the price comes down to 44.21, and the queue here is going to start to shrink as trades are made at this price. And then when you get to the front of the line, you have an opportunity to get your trade, right? Market can't go below 41.21 if you have a bid here. Without giving you your trade, right? That's the definition of a limit order. We'll talk about that in a second. On the right-hand side is the offer column, or where we sell. We call it, you can see at the top, it says buy, sell. It's offer. So bid, offer. Sometimes the offer is referred to as ask. And that really depends on how old you are. In any event, so that's the depth of market. 10 ticks deep, right? You see data 10 ticks deep, and again, the trader in Tokyo or in China or in Australia sees the same thing in those columns as the trader in Seattle or in Chicago or in my case in Charlotte, North Carolina. So that's the transparency of doing this. Now, in an equity trade, right? First of all, to get this to trade stocks, you're going to have to have a $25,000 pattern day trade account, right? So right away, that $25,000 hurdle is going to eliminate a lot of people from being able to participate with these great tools, right? In futures trading, that's not true, right? In futures trading, you get access to this if you want it, and you could fund with considerably amount of money less, right? More capital efficient here on the futures side of things. So that's kind of number one. And number two, don't forget when you're trading equities, you're probably routing orders to an ECNs, or some entity that's going to sell your order flow sell your order flow to somebody, and then you're going to get filled where you're going to get filled. So it's completely different here. There's no middleman taking this order. This is from your trading software to the appropriate pathway, internet pathway. It gets to the exchange, and that's the data you're seeing here. So that's a huge thing. Over the counter instruments, you never will see this because there's no organized database of volume, right? There's no, Bitcoin, you're not going to see this. You're not going to see this, the whole entire market in one place. Stock options, forget about it. We'll talk more about stock options later. So in any event, this is it. This is the trading ladder, and in placing a trade here is really easy. And I'm just going to go ahead and just throw a couple of trades in here really fast. So as an example, let's say that I wanted to say, you know what, if the market gets to 44.23, I would like to buy a contract, right? This is my thought process, because then I think once I do that, then the market will go back up and I'll be able to sell it at a higher price. So I'm going to click once. Easy as that. I'm clicking on the buy side. I'm clicking in the buy column, right? And if I change my mind, I can click that X and I could cancel it if I want. If I want to change the price, I could cancel and replace it. I can click on it and move it to a different price. Click again. It's that fast and it's that easy. Alternatively, on the flip side of things, if I want to sell a contract at a price, let's pick a price up here at 25 even. I just click once on the sell side, right? And now I'm sending limit orders to the exchange. I'm in a real-time simulation mode right now, so I'm not really sending them, but I'm in line now. I would be in line now. I'll be behind, 139 other contracts, 264 other contracts. And you can see the bids and offers are dynamic. They're moving, they're changing. People are canceling them. When I say people, traders, systems, whoever's participating in the market. So it's very dynamic. It's very dynamic. And if the market gets to me and I get my fill, that'll be great. And so we're going to just kind of leave those there here, and we'll see what happens if we actually do get a fill. In placing stop losses is equally as easy, right? So for instance, if we were to buy a contract here at 22.50, best practices usually is to place a stop loss order in case you're wrong, in case the market's not going to go up, it's going to go down, and it's going to exceed your risk threshold for the trade. And so what you would do is you would just move to the sell side here and just use the mouse roller, the middle mouse key, and click, set a contract size and hit the checkbox. And now we have a stop. This is a stop loss, right? Now, lastly, you could always, do a market orders. You click on the market here on the buy side, click on the market here on the sell side, and you immediately get filled at the best available price, right? It's just saying, hey, buy me a contract at the best available price, sell me a contract at the best available price. So it's really that fast, really that easy. And these things are actually measured in milliseconds, if you can get your head around that. Things, really the constraints these days are local internet connections. And most people have super fast ones right now. I just moved, like I said, to Charlotte, North Carolina, and I got Spectrum internet. And you can see it's moving pretty fast here, even through the distribution through the YouTube channel. Okay, so let's just take a time out here and look at some of the questions. Brian asked, my Superdome shows just one number in both the buy and sell columns. Is there an adjustment? Okay, so there's two types of data, right? There's depth of market, which are 10 ticks deep, and there's best bid in offer, which just shows the top, this 102 in this 21. If you have, and it's a price difference thing, it's CME, the charges so much for the depth of market. If you want to see all 10, if you want to spend a little bit less money and just get the bid and offer, that's called top of book or best bid and offer. And that's probably what you signed up for. So I would check with whoever your broker is. And if you want to, there's probably a process where you can go ahead and change that to get the entire 10 ticks deep. Hopefully that makes sense. Anthony asks, can you please go over tick versus tick increment? Yeah. So let me just kind of move this over here, and let's just pull a chart here too to help explain this a little bit better. And so here's a graphical representation of the trades that I have working, right, that I've already sent. I'm trying to get filled here. And you can see that the price is moving on the right-hand side, right? So the chart is actually showing a candlestick, and every time that we have a price change, it moves around on the actual chart itself. Now, the tick is just the nomenclature or a word for the smallest price increment available, the smallest price increment that this market will let you go. And the E-mini S&P is traded in quarter points. Each quarter is called a tick. Each quarter is called a tick. So 44.23 even, and then the first step up is 44.23 and a quarter. That's, a quarter, and then a half, 3/4, and then 24. That's a full point, right? 23 to 24 would be a full point. Otherwise, it's traded in quarters. Does that help? Does that help? And sometimes the tick sizes are different, right? Sometimes the tick sizes are different depending on the market you're looking at here. But for this particular market, and many of them are, exactly that. Now, one tick in this market, in the E-mini S&P market, is worth $12.50 per contract. So I just have one contract on, and you can see my P&L moving, right, here on the chart in this little label here. Green means I'm long one contract, and that's my P&L in the center. It says 0. It's moving around real time, mark to market. Let me just move the stop loss down a little bit so I have more time to explain. On the trading ladder here, you could see that the P&L is now minus $12.50. And what that's telling me is, hey, Jim, if you liquidate your position at the yellow price there, mark to market, where the market is, then that's what your P&L is going to be on this trade. That's what your P&L is going to be on this trade. So let's let that percolate a little bit. Let me look at the questions here some more. How can I get the charts to show the entire day? Mine is a big gap as I move the chart to the right. Yeah, I would get with the platform support. And there's a way to do it here really easily. Just take a screenshot, and then you could literally email support here, and they will give you the correct configuration if there's something you need to do differently. It's the fastest and best way to go, and they respond right away. Okay. Henry asks about net change. Yeah, you could do percent. You could do. He's asking about the market analyzer. Here, and then everything's right click, right click. And so when let's go ahead and look at the columns here. There's all sorts of columns you could add to your there's a lot of columns you could add. I just said these. I have instrument, last price, daily volume, net change. And when you highlight the net change, and I think this might answer your question, Terrence, then you could change your units, right? You could do points, percentage, ticks, whatever you want. I have mine set at points. You probably have yours set at percentage. That's all. So again, once you add it to the configured section, you could highlight it, and then you could change your unit, right? You could change, everything's customizable in NinjaTrader. It's awesome. Okay. I'm going to close that. Hopefully that answers that question. Nice. Thank you, Robert. Robert is admiring my volume profile. We'll talk. I'll get to that in a little bit. So PC asks, what's the ZB 1221? So ZB is the U.S. Treasury bonds, the classic U.S. Treasury bond market. That's this 12 stands for December, and 21 stands for the year 2021. And contracts expire. This contract expires every quarter, and there's a new one the next quarter, and the next one is going to be the March 2022 contract. And NinjaTrader software will warn you when it's time to trade in that next contract month. Great question, though. Love the question. The yellow highlight, Anthony, is where the last trade on the trading ladder. This yellow highlight is where the last traded price occurred. That's when someone says, "Hey, what's the E-mini S&P trading at?" Well, it's trading at 23 3/4. I just look at the yellow, 23 1/2 now. So that's what that is. Okay. All right. So I think we're caught up more or less. Priscilla, this question was answered by Iskander. Your chart scrolls left and right. If you click and hold the mouse button in the middle of the chart, if you click and hold the time, okay. So I think this was a chart management kind of thing. So you could click and hold the the y-axis and span it up and down. You can click and hold the x-axis and expand it backwards. If you hold your control key down on your keyboard, you could grab the chart and you could kind of just move it wherever you want. So that's a little, that one's a little less intuitive, but just hold the control key down, grab the chart, and then move it around, and you're in good shape. Okay, so let's go back to our trade example really fast. This is the anatomy of pretty much every trade ever made, right? We have a position, +1. We have a profit target that we put up here to sell the contract to make us flat. And then we have a stop loss down here in case we're wrong. And you could do things like manage your stop loss by trailing it upward if you'd like. You could do the same thing with your target if you'd like. So you have that flexibility to kind of do what you want right now. And you can see our P&L now is doing okay. And it's, remember, $12.50 per tick per contract for this particular market. Okay, Terrence, awesome. Lou says, I may have missed this. So near the end, would you show how to add the market analyzer and DOM next? Yeah, no worries. I mean, it's really as simple. It's as simple as going to new and then going ahead and clicking on whichever one of these things that you want. You could add a new chart as an example. And you could add a new DOM here. Let's click on the DOM. And what it's going to do, it's going to open it. It opened it up on my second screen, but it's going to open up a DOM. And then you could just grab the top part and move it around to wherever you want. Close that. Same thing with Market Analyzer. Just click on the Market Analyzer option in the new, and it's going to give you a new Market Analyzer. And then you could move it around and configure it to wherever you want it to be configured. Okay, so cool beans. I love that, especially now that I'm in the South. I love that expression. Let's kind of move over to the YouTube channel. Oh my God, we're not going to talk about that platform. Ramona, you're welcome. What, Toby, what are you talking about? So Bob, Tuesdays and Wednesdays, we do a trade setup event. So I would encourage you to come to the Tuesday and Wednesday live trade setup event. And we do a lot of technical analysis and stuff like that. All right, so let's I'm way behind schedule there. So let's kind of move forward here and I'll go back and get more questions as we go. We talked about paid or day trade, kind of blocking a lot of us out of participating. We talked about all the different asset classes, but one thing I do want to mention, which again is unique to this particular type of trade markets, is the idea that these are nearly traded around the clock, right? They're 23 hours a day. And then I'll use Central Time as my example, right? So Central Time, Sunday afternoon, 5 p.m. Central Time, the market opens up. It trades all night Sunday night, all morning Monday, all day Monday, and then closes at 4 o'clock. Closes at 4 o'clock for 1 hour. And then Monday evening at 5 p.m. it opens again, 23 hours, closes for 1 hour, and Tuesday afternoon. And this cycle repeats itself all the way till Friday. Now, the one thing that's important to know, first of all, you have 23-hour access, right? You could express your opinion on price, participate in the markets anytime. And remember, this is a 24-hour news cycle, right? Geopolitical events happen, 24 hours. Different countries start their trading different hours throughout the globe. So you do have this ability to participate whenever you want, really. And let's just look at a U.S. example. So in the U.S., let's say that maybe one of the big NASDAQ components is going to release earnings after hours, right? After the cash market opens up, and you don't have access to the cash market because you can't trade at night because you don't have a pattern day trade account. Well, you could trade here. And you could express that opinion in NASDAQ, and you could make that trade in the NASDAQ market after hours, because there's nothing special for you to have access to that to trade at night. So that's just one example of that kind of phenomenon. And a lot of traders like to wait for the Germany to open up. A lot of people in Frankfurt, the Eurex exchange, folks would like to trade the open and when London opens up, right? A huge financial center. So in any event, that's another thing. 23-hour marketplace, and there's a margin thing that I'm going to talk about in a second, but let's get to that. We're almost to that place right now. We're almost to the margin discussion right now. Actually, we're at the margin discussion right now. So let's go ahead and talk about that. This particular trade that I'm making right now, right? I'm long one. The way we'd say it is I'm long one E-mini S&P. I'm long one ES, right? I bought one. If you go up to the top of the screen here, you'll see a bunch of columns in the control panel, and one of them is intraday margin. I'm using $500 worth of intraday margin. And margin is different in futures than it is in the equity world, right? I'm not borrowing this money, right? In equities, you're trading on margin, you're borrowing, maybe you're getting 2-to-1 leverage at the most. Maybe you're not. But in futures trading, what it's doing is saying, hey, Jim, you have $14,700 in your account, right? And maybe you have, I don't know, maybe you only have $3,000 in your account. That's a little bit irrelevant to what I'm about to say. But what it's saying is, hey, by having that position on, you are allocating $500 of intraday margin of your total balance. So your excess intraday margin is $14,291. And what that's telling me is, I'm using up $500 in my day trade margin or intraday margin, and I could actually buy another contract and I'd use up another $500 worth of my excess margin. And so I'm not writing a check or sending a wire or anything for that money. It's in my account, but it's just an accounting kind of mechanism to say, here's how much leverage that we're affording you right now. Here's what you could trade. Remember, leverage is a double-edged sword, especially day trade margin. It works for you as well as against you, magnifies gains as well as losses. So take it easy with the day trade margin, but that's how it works in futures trading. Right. And maybe you have a smaller size account, which means your leverage is magnified, right? You're using $500 day trade margin to trade this contract. And the notional value of this contract, let's say it was trading at 44.24. I got to get my calculator out to do the math, but at a price of 44.24, I would multiply it by the point size, which is $50. Remember, $12.50 per tick, and a whole point is $50. And the answer to that is, 44.24 times 50 is $221,200 of S&P market I'm controlling with that. A lot of leverage, right? So be careful with that. That's how notional value works. And then you can go across the board and you can see initial margin. Well, what's initial margin? Why is that so much bigger than intraday margin? Initial margin is really for position traders that want to hold their position overnight. And as odd as it sounds, overnight's only 1 hour, right? But this is set by the CME group. There is no negotiation involved, and this is kind of set in stone. So you'd never want to be in violation of your intraday margin. So now when I take my 12,000 intraday margin I'm using and I subtract it from my cash value, now I have excess margin of only 2,666, right? It's a big number. So if I wouldn't be able to hold 2 contracts over because I would have an excess initial margin deficit. It would be negative, and it'd be a margin call, and everybody would be mad at me. So that's and you if you're not out of your position by 3:45, you may get liquidated. You may get charged a liquidation fee. So you want to keep that in mind, right? That's the 2 different types of leverage. Intraday margin, day trade margins are assuming that you're going to liquidate your position before the end of the close that day. And maybe you'll make several trades that day. You'll open and close several trades that day. And that's another benefit of futures trading over the equity world is you don't have to wait for anything to settle, right? As soon as I liquidate this position, let's do that. I'm going to kind of just move my target down to where the market is. And so now I sold it at 23 3/4. I'm going to cancel my stop. And I'm totally out of my position. My intraday margin is 0 again. Well, now I could go ahead and do another one. I don't have to wait. Now, I already had enough day trade margin to do another one anyway, but if I didn't have enough day trade margin to do another one, I could do another one. I don't have to wait. There's no, ridiculous settlement process anymore, right? And as a matter of fact, I can put 2 contracts in the order book, and look what happened to my intraday margin. It's saying, okay, Jim, you send 2 orders at 2 different prices to the exchange, which might be a legitimate trade strategy, but now you're using $1,000 to do that. Right. So it's straight up math. It's pretty easy to figure out. The next column's over, realized P&L. This just said realized means I closed the trade. And this is how much money I made or lost, right? This is my gross profit. And this trade was $62.50, which equals 5 ticks, right? 5 times $12.50 equals that. Unrealized is going to be on positions that are open. Let's get an open position. I'm just going to go ahead and try to get an open position. And so this unrealized profit now is associated with the open position. And you can see it's going to move around in real time until it's closed. Total P&L is simply unrealized plus your realized. And that idea is kind of a finance idea in general. It's not totally unique to future trading, but it really opens your eyes to what unrealized P&L is versus realized P&L. So when you hear talk on the TV about, we're gonna start taxing unrealized equity P&L, that's what it means. It means that, okay, if you're up a bunch of money and you haven't liquidated your position, you're going to have to pay taxes on the profit that are unrealized, which is probably going to be a non-starter ever in the U.S., by the way. But that's kind of the same concept here. Okay, so Brian says, how do you calculate how much one has to have in their account cash value to trade per contract? Well, okay, of an instrument, i.e., if I have a small account, say $3,000, and want to trade 5 contracts of ES at a time, we know that the E-mini S&P, in my particular example, day trade margins in most brokerage firms are similar, is $500 a contract, right? And so if you want to do 5 contracts, it's 500 times 5. You're going to be using $2,500 of your $3,000 for the trade, for margining purposes, right? So it's multiplicative. I can't say that word. Math, right? So that's how you want to do it. And all brokerage firms will have a margin table that you can go to and just look up what the day trade margin is for that particular instrument. Okay, Rush and Roll from welcome back, Rush and Roll from Facebook. Are you talking about the band Rush, by the way? I'm old enough to know who they are. How do you know when you are about to be margined out? Well, look at your control panel. I mean, it's going to tell you, what your liquidating value is, right? And my liquidating value right now is 14,800. I'm not close to being liquidated out. I probably should have started with a smaller sim account to show it a little better, but this is going to show you what your net liquidating value is. That's going to include your open and closed trades for that day and your unrealized P&L for that day, right? And then the second thing you're going to look at is, what's your excess intraday margin? Is that still positive or is it negative? So those are the 2 things you want to look at. And again, don't over leverage. Going back to the $3,000 5-lot example, Brian, in my experience, and I've been doing this forever, I'm very old, that's a dangerous recipe to routinely do 5 contracts in the ES with $3,000 in your account. Because what's going to happen is it's going to magnify your profit and losses, right? And when you're trading real money, there's way more going on than just your technical analysis, right? There's all of the demons in your head, right? The adrenaline, the dopamine, the serotonin, all of these things are creating behavioral, subconscious, maybe conscious behavioral changes. And most folks, behave differently when they start seeing a large loss versus a large gain. So be careful with that. And you know, the volatility nature of this market could stop you out really quickly. So really be careful. Your example is a little extreme for my taste. You could probably do it, but again, I've seen a lot of traders come and go, and that's probably one of that's in my top 10 mistakes list. Okay. So Henry, has got a great question. I think we're a little bit, I'm going to answer it anyway. I'm going to read it out loud and answer it anyway. Henry says, what's the difference between initial margin and maintenance margin? So these are both set by the exchange. Initial margin is typically 120% of maintenance. And what it means is you need initial margin to establish the position if you're going to keep it overnight. And then you need maintenance. You need to meet that lower maintenance margin to hold it overnight, right? It has nothing to do with day trading, right? That's a initial margin and maintenance margin is an idea that kicks in if you decide to hold a position overnight. That's all. It's 120% difference. Initial margin is what you have to establish it. Maintenance is what you want to hit, what you have to maintain it to carry it overnight. Right. And that was more important before the electronic revolution because a lot of traders were doing just that, right? Because it was hard for us to participate, right? This was not accessible to everybody. Now it is. No, I got you. Brian. And my comments really were, I wasn't calling you out or picking on you. My comments were more just, I want everybody to understand that. I feel strongly about it. So everybody's listening. I want to understand. Don't over leverage. Don't over margin your account. Okay. Where are we at here? I've lost track of everything I was talking about. Sorry about that. I get too excited and too carried away. So we talked about, you know, the 23 hours. We talked about the margin being freed immediately. Let's talk about the type of trading that could happen here. Right. And, you know, I'm going to go back to a global overview of futures trading and why it's so attractive, not only with the transparency, electronic trading, all the different asset classes, the liquidity, the volume that you see here in a lot of these marketplaces. I mean, look at the 6E, by the way, the Euro FX has got 125,000 contracts in it. That's pretty good. But there's day trading, right? Which is probably why most of us are here. And that's what, you know, we experience most. And that's, you know, opening and closing positions within the same session, right? There's position trading, right? And position trading is you open a position and you want to hold it for a while, right? Maybe you want to hold it for, overnight or a week or a month or however long you want to hold it for. Now, keep in mind also, there's not an options expiration problem here, right? If anyone's ever traded options before, it's frustrating, right? Because you have this time decay on your option. You pick a strike price, and you're going calls and puts, whatever your strategy is, and then you're up against the clock right away. Right, you're up against the clock. Here, you're not up against the clock, right? These are 3-month contracts. You could always roll over to the next 3 months, and so that limitation is kind of gone away a little bit, right? You don't have to worry about that limitation. What you have to worry about is making sure you have your initial margin covered, and then you're good to go to hold that position for as long as you can. And we see this with institutions and other types of entities. In the middle there is a thing called swing trading, right? Today's a bad example of a swing trading only because this has been a one-way rally up today, really. But on a typical day, you're going to see the market go up and down in some kind of wave process, some kind of oscillation process. And a swing trader is going to try to pick off the waves, right? Buy the low part of the wave, sell the high part of the wave. Sometimes that happens within a day. Sometimes it takes more than a day or so for that to happen. That's called swing trading. That's kind of in the middle, right? That's the middle one. Day trading, swing trading, position trading. Now, actually, you know what? I forgot to show you guys. I'll show you this at the end. Hang on. And then within those types of traders, you have different types of institutions, right? We have the retail trading, and you hear this term on TV as well. You hear this term, the rise of the retail trader, and the micros certainly help us with that. Not only from maybe you have a smaller amount of money you want to capitalize account in, but also it's a good training ground if you have a bigger amount of money to kind of get in the flow of how the software works and how the money works. And so you have this whole there's a huge retail component here of traders around the world, right? And we have folks in here from Holland, right? And other places. So, and then there's institutional traders. These are typically money managers or large institutions that manage money. And these folks typically, they take positions and hold positions for a long period of time. Then there's commercial traders. And those, when you hear the word commercial, typically that's related to hedgers, right? So, a couple examples of hedging, the classic one is, the farmer wants to lock into a price to sell his corn today. They don't want any price risk because they don't know what's going to happen when they harvest the corn. So they'll go ahead and lock into a price by making a futures trade. That's a typical textbook kind of hedge scenario. Another one might be, hey, I want to buy some semiconductors from Japan. I'm a US-based company, and I'm going to have to convert my US dollars to Japanese yen. But I want to lock into a price now, even though I don't have to purchase the semiconductors in yen until March. And that's another example of a hedge, right, where they want to try to lock in price. And there's millions of examples of this. The last category is the systems traders, the algo traders, right, the computer traders, and they get a bad rap. System traders get a bad rap, but I don't think they deserve it. And here's why: all the algos that are going on right now, they're trying to exploit bid-ask spread in milliseconds, in and out quickly, and it's what it does is it provides this liquidity, right? These tight bid-ask spreads, this extra volume, which is good for us because the wider the bid-ask spread, the more expensive our trade is, right? So at the end of the day, in my opinion, these are really good programs to be in, and really good to be in this particular market because they add this extra liquidity, which creates this tightness, these tight bid-ask spreads. And you go ahead to make an option. Let's go back to my option trade example. You pick a strike price. A lot of times you're going to see the bid-ask spread is pretty far apart, right? And it's hard to overcome that bid-ask spread on the entry and on the exit, right? And that's going to add to the cost of your trade. So I'm not gonna disparage the systems guys. I think they add a purpose to the market. This brings me to cryptos. You could do micro Bitcoin. It's still kind of in its infancy here at the CME group. I don't know what the whole Bitcoin market's a little confusing to me. There's not really an underlying asset like you have in just about all of these other markets here, even the ones that are cash settled. There's an underlying market, underlying commodity, underlying interest that is there. And there isn't really one so it's completely speculative, and it's hard to do technical analysis, in my opinion. I don't know if it's a flight to quality instrument or not. I'm not seeing 100% correlation there with respect to that. And, blockchain technology is different, right? Blockchain technology is how to protect transactions. And that's it's kind of different, right? It's kind of different. And not only that, I mean, there's more than just Bitcoin, right? There's all sorts of other cryptos you could trade. And so this idea that there's a limited supply of them is false. There's an unlimited supply. So when you have the opportunity to trade different types of coin, then it's kind of like over-the-counter Forex, right? There's different places you can go to place your trade at different prices. So I'm not a huge fan yet. We'll see what happens on the futures market side of things, see if it gets more liquid and going. So I do want to show a spreadsheet though. Oops, sorry about that. If I could find it relatively easily on my little cheat sheet here. Just to kind of wrap it all up, put it all together, and we'll go back and answer questions. Like I said, it's 1 o'clock now, but I have time. We have time. So here is a couple of examples. So I have an E-mini S&P, classic E-mini S&P example, a winning example. I have a classic E-mini S&P losing example. I have a micro winning example, and I have a micro losing example. And let's take these one at a time. So on the ES is the symbol, right? And if we were to buy a contract and our purchase price was, 41.20, and we sell it at 41.24, we would have made 4 points or 16 ticks. Our gross profit would be $200, right? Because it's $12.50 a tick or $50 a point. So I'd multiply 50 times 4, I'd get $200. My day trade margin for that trade would have been $500. The notional value in this particular example is going to be about $206,000, right? That's a lot of market we controlled with that trade. Let's say we decided to do 2 contracts on the same prices, right? We made 4 points on this trade. We bought 2, we sold 2, and now our gross P&L is $400, right? So it's doubled. A multiplicative. I said it right that time. Day trade margin is 1,000. Notional value 412,000. And so you could see as you scale up how things get bigger and bigger, and you do have to be careful depending on what your account size is. But and leverage is a function really of your account size. And not only your day trade margin, but your notional value, right? So if you funded your E-mini S&P account with $206,000 and did 1 contract, you would have no leverage, right? It'd be basically no leverage. If you funded it with 100,000, it would be 2 to 1, and that's what you get with equities. If you fund it with $3,000, which you could, it would be your leverage ratio is high, right? So that's how that idea of leverage works. On the losing trade, same thing, 1 contract, 2 contracts, or 5 contracts. We buy it at 41.20, same purchase price, but the market goes against us, and we decide to get out at 41.16, and so we lost 4 points. 4 times 50 is minus 200. We would have used the same day trade margin, and our notional value would have been the same. So double it up, we're losing 400, and then if you did 5 contracts, it would be 1,000. Now let's take a look at I'm going to try to get the micro on the same level here. My spreadsheet is the big one here. Let's take a look at the micro. Same thing, 1 contract, 2 contracts, 5 contracts, same purchase and sell price. Now, our profit is $20 instead of 200. Everything's 1/10 the size, right? So instead of, I got an order filled. So instead of $12.50 a tick or $50 a point, it's $1.25 a tick and $5 a point. So it's 1/10 the size, and there's a lot of advantages to doing micros over the big ones. You could end up with 4 micros, which is 40% of a big S&P, or a classic E-mini S&P, as I call it. So if just looking at the winning and losing trade examples, it's the same thing, only divided by 10. Right. So it just kind of gives you a flavor. So no matter what level you're at with risk capital, or no matter what skill level you're at, you have the ability to participate in many of these markets with the micro contracts, which are completely awesome in my humble opinion. Okay, sorry, I was supposed to show that slide earlier. I didn't see I didn't read my notes. Anyway, we're good there. I'm going to move over here. And one last thing. We did get a second unit on our trade idea, right? Our second unit on our trade idea. And you can see our intraday margin now is 1,000 instead of 500. And look at my excess initial margins, negative. I do not have enough money to carry both of these contracts overnight. I don't. My unrealized P&L, everything's doubled, right? I have 2 contracts on now. So each tick isn't worth $12.50 anymore. It's worth $25. So you can see how the numbers could kind of add up. So be careful with that. Mark to market, there's our price. It's, we're trading at 20 3/4. And that gray area up here, which is high, which shows us tan area, I guess, brown label here shows us where our entry was at, where our price is at. All right. So am I missing any questions that I shouldn't be missing? Let me kind of scroll back up here. Okay, so Daniel asks, are contracts traded in parallel? For example, ZB 1221, which is the December contract, and then the next one, which would be ZB March 2022, which is the March contract of next year. Yes. However, because these contracts started a long time ago, so you could trade them both, and some people do spread between the two. But that's kind of a rare thing with these days with this market, because the December contract is very liquid, right? If we wanted to look at the December contract for the bonds, and let's see if I could readily find it here without causing too much pain. We'll go ZB, click on it. Let me just kind of move it over here. You're going to see that it's a very liquid market. Look at the bids and offers. There are hundreds and hundreds, right? The March contract is going to be a lot less liquid. So from a day trading point of view, it's usually best practices to focus on the front month, which is more liquid, and the bid-ask spread's tighter, and you have a better chance of getting in and out at the price that you want. So you could do them both. There's going to be a point when coming up soon when the March contract volume is more than the December contract volume, and then it's time to focus on that particular market. NinjaTrader software warns you, it tells you, hey guys, it's time to switch. I'm not even sure. Futures day trading asks, does NinjaTrader have some kind of demon account NQ trading competition? I don't know, not that I'm aware of. The number in the parentheses, that just says, hey, two contracts, there's a 2-contract trade instead of, a 5-contract trade, a 1-contract trade, and it'll move around. Right now, this market's kind of middle of the day. It's kind of slow. Treasury bonds tend to move early. If you take a peek back at the ES, and you can see that number in the parentheses right now, 1 contract traded. That's the size of the last transaction. That's all that is. There's nothing magic in there. It's hard to see, it goes so fast. MA says, hi, can you share your sheet? You know what, shoot me out that particular spreadsheet. Shoot me out an email at jim.cagnina@infinityfutures.com. I'm sorry, jim.cagnina@ninjatrader.com. My bad. Bad muscle memory. Apologize for that. jim.cagnina@ninjatrader.com. Jim asked, do you need 25,000 to trade from 6 to trade at night? And he's quoting US hours. The answer is no, you do not need that to trade at night. Your margins might be a little higher. Your day trade margin might be double, as an example. Thank you, guys. Appreciate that. NinjaTrader folks, pop that in. My colleagues, I'm not sure which colleague is here with me today, but I appreciate your help. Scrolling up here, guys. Scrolling up. All right, I think we're good on that side. Let me look at this other question box. Okay, so Lou hates to beat a dead horse. That's okay, I'm pretty good at it. However, using the ES as an example, it appears that I was wrong in thinking that one needs to deposit initial margin of 12,100 into the account in order to trade any amount. You are wrong, right? Let's say, as an example, you want to fund your future trading. In every brokerage firm is different, but if you want to trade a lot of firms will allow you to trade with a lot less than that. Let's say $3,000 in your account, and you could day trade, right? If you're day trading, you're liquidating your positions before the end of the day, and you don't need to have that $12,100 in your account to participate. So that's one of it's part of the capital efficiency process that we see here, right? With respect to futures trading, right? When I say capital efficiency, it means you don't have to lock up $25,000 or $12,100 in your example of your capital if you're simply going to day trade, and you're going to do it in a way where you're not carrying positions past that 1 hour close, right? So now you could use the other $9,100 of capital to do something else with, right? Now keep in mind, you're magnifying your leverage by doing that, right? So, for every dollar you invest, you're magnifying your leverage, and you got to be careful with that. But for sure, you don't have to do that, right? For sure. Whew, cool beans again. Two cool beans in one meeting. All right, it's 1:11. We're getting close to closing time here. I'm scrolling up. All right, so we're in double overtime here. I appreciate everybody for coming. If I missed your question, we're going to do it again next week. We have our calendar on the NinjaTrader training page, and my NinjaTrader colleague here will cut and paste that link into the chat box. It's platform trading. So ninjatrader.com/platform trading. And you're going to be able to see the schedule of education events. And there's a lot of them, right? Tuesday and Wednesdays, we look for live trade setups. And we're constantly adding to that list. There's a whole bunch of stuff on there. Thank you. And I'll go ahead and just paste this into your system. So Dan asks, let me try to answer this question again. How do you know when you've used too much intraday margin and you'll get liquidated? Well, there's definitely you're going to look at your intraday margin versus the amount of money you have in your account. You're going to look at the excess intraday margin. Is it positive or negative? And you're going to look at your net liquidating value. And so, for instance, if you have one contract on an E-mini S&P, and your net liquidating value is on a big E-mini S&P, not on a micro, is getting low, less than $1,000, less toward $500, then that you're in trouble with that. That's too that you don't have enough money. You got to be careful. You don't get in a deficit situation. So it just depends. It just really depends on the combination of markets you're trading and the amount and the volume you're doing. But just keep an eye on those two columns, and that's really kind of important. And each broker is going to do something a little differently, so just be careful with it. So order flow volume profile, I'll do that really quickly. This is a little bit more advanced. We cover this on Tuesdays and Thursdays. This is these histogram bars on the right. I'm just going to go ahead and right click, and I'm going to go to indicators. Everything in NinjaTrader is really easy. It's right clickable. And then I scroll to my available indicators, and I look for order flow volume profile. I highlight it. I add it to the bottom. Once it's on the configured section right here, once I've added it, I'm going to highlight it in the configured section, and it gives me all the ability to change all the parameters that I want, right? Tick per level, I have set it 2 for today. You could scroll all the way down, changing colors and stuff, show volume labels and all that good stuff. So that's how I did it. I just right-clicked on the desktop. I opened my indicators, and there it was. And I have the order flow volume version of the software up and running right now. I'll leave that up for a second so you can see it. Caroline, great question. Caroline says, how do you determine your entry? It's not easy. It's not easy. But what I suggest is come Tuesday and Wednesday to the live E-mini S&P trade setup events. And that's all we do. We talk about what's a good idea, what's a good entry price based on, one, the fundamental analysis that I already did earlier in the morning, right? The macroeconomic stuff. The analysis we do in the morning, and then the technical analysis we do live on the chart itself, right? On the chart itself, we're going to look for, we have an oscillator, we have a moving average cross at the bottom. We're going to use a Fibonacci retracement line. We're going to use a lot of tools at our disposal to try to determine scientifically where's a good place to enter, where's a reasonable place to put our stop loss, where's a reasonable place to put our profit target. And we spend a lot of time doing that on Tuesday and Wednesdays. Again, it's free. You can come anytime you want. And it's a lot of fun. We have a lot of give and take back and forth in that particular events. So if just follow that same link that our host has cut and pasted into you, that ninjatrader.com/platform training link, just feel free to click on that, and it'll be on that schedule right then and there. And I actually cut and pasted into this Zoom chat. It's also in the other chat. Okay, so I do want to remind everybody trading futures, options on futures involves substantial risk of loss, not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility, although it's an equation for opportunity, also equation for risk, only fund with risk capital, easy on the day trade margins. We're in a real-time simulated account today. And I want to leave you with this. Be safe out there and be good to each other. Thanks for coming.